1 minute ago, something happened in the silver market that most investors will completely overlook. It wasn't loud. It wasn't dramatic. There were no flashing headlines on mainstream financial television. But beneath the surface, the kind of activity that typically precedes major moves just showed up. And it showed up in size. Silver ETF volume just exploded. Now here's the question that matters. Why? Because volume is not noise. Volume is intent. Price can lie. Headlines can mislead. But volume, especially abnormal concentrated volume, reveals positioning. And when positioning changes, direction often follows. Today's spike wasn't random retail buying. It wasn't a social media frenzy. It was coordinated, heavy, deliberate flow. The kind of flow that doesn't chase momentum, it builds it. And that's where this gets interesting. Over the past several sessions, silver has been volatile. Sharp drops, quick recoveries, emotional swings. Retail sentiment has been shaken. Some holders are nervous. Some are confused. A few are already capitulating. And that emotional instability creates the perfect environment for something else to happen quietly in the background. Accumulation. Historically, explosive ETF volume in silver doesn't show up at market tops. It tends to surface during uncertainty, when conviction is weak and prices are under pressure. That's when larger players step in, not to chase hype, but to secure positioning before momentum returns. And here's the contrast most people miss. When retail investors see red candles, they interpret risk. When institutions see fear-driven selling, they see discounted exposure. The same price action creates two completely different psychological reactions. One group reacts emotionally, the other reacts strategically. So when ETF volume surges while sentiment is shaky, that's not random. That's asymmetry. Now think about the broader backdrop. Inflation remains structurally elevated, real rates are unstable, liquidity conditions are tightening in some areas while quietly expanding in others. The macro picture isn't clean, it's fragmented, and fragmented environments are where precious metals begin to regain relevance. But this move isn't about headlines, it's about flow. ETF volume acts as a bridge between institutional capital and the physical market narrative. It reflects where larger pools of money are allocating exposure, and today's activity suggests something very specific, positioning ahead of a potential shift, not confirmation, positioning. That difference is critical. Most investors wait for confirmation. Confirmation feels safe, it feels rational, but by the time confirmation arrives, much of the move has already occurred. Smart capital doesn't wait for clarity. It anticipates imbalance. So the real question isn't whether silver is about to explode tomorrow. The real question is why sophisticated money is increasing exposure while volatility still scares retail participants. There are only two possibilities. Either this volume is a false signal, temporary noise in a directionless market, or this is early positioning before a structural repricing begins. History suggests that when abnormal ETF volume appears during unstable macro conditions, it rarely means nothing. But let's go deeper, because volume alone isn't the story. It's what's happening simultaneously in rates, in currency strength, in risk assets, and in liquidity flows that makes this moment different. Silver does not move in isolation. It responds to pressure, and pressure is building across multiple fronts. If capital begins rotating defensively, silver stands to benefit. If rate expectations shift even slightly, silver reacts disproportionately. If confidence in policy stability weakens, silver absorbs that uncertainty. And right now, positioning suggests someone is preparing for exactly that scenario. This is not about panic, it's about awareness. When the crowd hesitates and volume expands, attention is required. Not emotion, not excitement, just disciplined observation. Because markets don't announce their turning points loudly, they whisper them first, through positioning. And today, that whisper just got louder. The next question isn't whether silver moved, it's why capital is moving before it does. To understand why this volume matters, we have to step back and examine how institutional capital behaves during transitional phases in the market. Institutions do not react the way retail investors do. They don't wait for headlines to confirm a narrative. They don't chase green candles out of excitement. And they certainly don't reveal their intentions after the move has already begun. Instead, they position during uncertainty, when volatility is high, when conviction is low, and when price action appears directionless. That's exactly the environment we're in right now. Silver has been moving erratically, sharp drops followed by quick rebounds, weak hands getting shaken out, social sentiment turning cautious, financial commentators calling it confusing. And confusion is a gift to disciplined capital, because confusion suppresses participation. When participation declines, price becomes easier to accumulate without triggering momentum-driven buying. Large flows can enter quietly. That's how positioning happens before repricing. Now look at the ETF structure itself. Silver ETFs represent liquid exposure. They are often the preferred vehicle for institutional money seeking rapid allocation without dealing with physical delivery logistics. When ETF volume expands abnormally, it tells us something very specific. Capital is adjusting exposure quickly. And that word quickly matters. This was not a slow build over weeks. This was a sudden surge that implies urgency, but not panic urgency, strategic urgency. So what could trigger strategic urgency in silver right now? Let's examine the pressure points building beneath the surface. First, rate expectations are no longer stable. Markets are beginning to price in policy shifts. Even subtle changes in forward guidance can dramatically impact real yields, and silver is highly sensitive to real yield movements. When real yields soften, silver doesn't drift upward, it accelerates. Second, liquidity conditions are uneven. Certain sectors are tightening, while others are quietly receiving injections of capital. This fragmentation creates volatility in currency markets, and silver, as a monetary metal, responds to currency instability faster than most assets. Third, risk assets are extended. Equity markets have been trading at valuations that assume stability, but stability is becoming conditional. If volatility begins to bleed from equities into broader risk sentiment, capital will rotate defensively. And where does defensive capital flow when trust weakens? Into hard assets. But here's the key distinction. Retail investors typically rotate after the narrative shifts. Institutions rotate before the narrative shifts. They move when data begins to whisper instability, not when media confirms it. That's why ETF volume matters more than price. Price can be suppressed temporarily. Algorithms can trigger stop losses. Futures markets can exaggerate intraday swings. But sustained ETF accumulation reflects deliberate capital commitment. Now, could this still reverse? Yes. Markets always retain uncertainty, but we must evaluate probabilities, not possibilities. The probability that sophisticated capital increases exposure during macro fragmentation without anticipating volatility expansion is low, very low. And here's the contrast that creates opportunity. Retail sentiment right now is cautious, fearful of another pullback, concerned about being early, emotionally reactive to short-term red candles. Institutional positioning, however, appears increasingly proactive. That divergence between fear and preparation is where asymmetry forms. Because if silver begins to break key technical resistance levels while institutional positioning is already elevated, momentum will not build slowly. It will cascade. Momentum driven by positioning, not speculation, is powerful. And the most dangerous phase for unprepared investors is not the crash. It's the sudden upside repricing that leaves them chasing. That's why today's volume spike matters more than today's price action. It suggests someone is positioning before clarity emerges. The market rarely gives everyone the same opportunity twice. It creates discomfort first. Then it rewards conviction. Right now, discomfort is high, and volume just confirmed that conviction is quietly increasing somewhere beneath the surface. The next layer of this story isn't about ETF mechanics. It's about what happens if this positioning continues while macro pressure intensifies. Because if those two forces align, positioning plus instability, silver won't drift higher. It will reprice. Now let's talk about what most investors are really feeling right now. Hesitation. Not outright fear, not euphoria, just hesitation. Silver hasn't given them a clean signal. It hasn't broken out decisively. It hasn't collapsed catastrophically. It's hovering in that uncomfortable middle ground where conviction feels risky and inaction feels safe. But markets rarely reward comfort. The most powerful moves in financial history don't begin when everyone agrees. They begin when uncertainty peaks, when narratives conflict, when confidence fractures. That's when positioning quietly shifts, and that brings us back to the ETF volume explosion. If this were simply speculative retail activity, it would likely coincide with hype, headlines, and price spikes. But instead, we're seeing something more subtle. Price isn't screaming higher. Media isn't panicking. Social feeds aren't euphoric. Yet capital is moving. That disconnect is psychological gold, because here's what typically happens next in environments like this. Retail investors wait for proof. They want confirmation that the trend has changed. They want a strong weekly close. They want analysts to revise their outlook. They want safety. But safety in markets is often expensive. When silver moves decisively, it doesn't move politely. It accelerates. And acceleration compresses opportunity. Those who waited for reassurance suddenly find themselves buying higher, chasing strength instead of building position during doubt. And doubt is everywhere right now. Some are worried about continued rate pressure. Others fear economic slowdown. Some believe metals will stagnate while equities dominate. That narrative fragmentation creates hesitation, and hesitation suppresses aggressive retail participation, which again raises the critical contrast. If retail is hesitant and institutional flow is increasing, who is likely operating with deeper data access? Who has broader macro visibility? Who can afford to position early? Smart money does not seek applause. It seeks asymmetry. And asymmetry appears when perception diverges from positioning. Now consider something even more important. Silver is not just an industrial metal, it's also a monetary metal. It sits at the intersection of economic growth expectations and monetary instability. That dual nature makes it extremely reactive to policy shifts. If growth slows unexpectedly, silver can benefit from safe haven demand. If inflation reaccelerates, silver can benefit from currency hedging flows. If rates soften, silver becomes more attractive relative to yield-bearing assets. That's three separate macro pathways, all potentially supportive. This is what makes positioning ahead of clarity powerful. You're not betting on a single outcome. You're positioning for instability itself. And instability is not disappearing, it's evolving. Now imagine this scenario. Volatility in broader markets begins to rise. Equity momentum weakens slightly. Bond markets react to shifting rate expectations. Currency strength fluctuates. Suddenly, silver, which has been quietly accumulating institutional interest, breaks a key resistance level. Momentum algorithms activate. Short positions begin covering. Retail sentiment flips from hesitation to urgency. And the same investors who felt cautious days earlier now feel pressure to enter. That's how repricing unfolds. Not slowly, not gently, but through a rapid shift in perception. This is why early positioning matters, not because certainty exists, but because probability favors those who act before consensus forms. Right now, consensus is unclear. Narratives conflict, sentiment is fragile, and ETF volume just signaled that someone is not waiting. The difference between reacting and anticipating often defines long-term performance. Silver doesn't need hype to move. It needs imbalance, and positioning creates imbalance. If this accumulation continues over multiple sessions, it won't remain quiet for long. Price will eventually respond. And when it does, the psychological landscape shifts instantly. Those who were calm during hesitation feel confident. Those who waited for clarity feel urgency. Markets transfer wealth during those transitions. The real question isn't whether volatility will continue. It's who is prepared when perception changes, because perception always changes faster than most expect. Now let's zoom out. Because what's happening right now in silver is not just about one spike in ETF volume. It's about positioning within a larger structural shift that has been quietly building for years. For over a decade, markets have operated under one dominant assumption. Central banks will stabilize everything. Liquidity will appear when needed. Volatility will be contained. Risk assets will be supported. That belief created extraordinary confidence in equities, in growth assets, in leveraged positioning. But belief is not permanence. We are now in a phase where policy tools are less precise. Inflation proved that control is conditional. Rate hikes proved that stability comes at a cost. And growth, while resilient, is no longer immune to pressure. When confidence in absolute control weakens, even slightly, capital begins looking for balance, not panic, balance. And that's where silver re-enters the conversation. Silver thrives not in chaos, but in uncertainty. It doesn't require collapse, it requires instability. Even mild instability is enough to shift capital allocation models. Now combine that backdrop with what we have just witnessed. A sudden explosion in ETF volume during hesitation. That's not random, that's preparatory behavior. Because institutions understand something critical about markets that retail investors often overlook. Cycles don't announce themselves at the beginning. They only become obvious in hindsight. Think about every major move in precious metals history. The initial phase felt ambiguous. Analysts were divided. Media coverage was skeptical. Sentiment was mixed. Then momentum appeared. And once momentum appeared, narratives changed overnight. Today, silver is not at euphoric highs. It is not dominating headlines. It is not the center of speculative mania. It is positioned in that quiet middle ground where accumulation can occur without attracting attention. That phase does not last forever. If macro conditions continue fragmenting, even modestly, the probability of silver repricing increases. Not because of hype, not because of fear campaigns, but because capital seeks hedges when confidence weakens. And confidence globally is not strengthening. It is becoming conditional. Conditional growth, conditional policy success, conditional stability. In conditional environments, hard assets regain relevance. Now here's the final contrast. Most retail investors operate reactively. They respond to what already happened. They wait for clarity, for confirmation, for validation. Institutions operate probabilistically. They position based on emerging imbalance, not confirmed outcomes. Today's ETF volume suggests probability is shifting, not certainty, probability, and markets move when probability shifts before perception does. If this positioning continues, if macro pressure intensifies even slightly, if real yields soften or currency volatility expands, silver doesn't need dramatic news to move. It simply needs imbalance to widen. And imbalance begins with positioning. Right now, we have three observable facts. Volume surged unexpectedly. Sentiment remains cautious. Macro conditions remain unstable. That combination is not common. When it appears, it deserves attention. This is not about chasing green candles. It's not about panic buying. It's about recognizing transitional moments before they become obvious. Because once they become obvious, the opportunity compresses. Silver has a history of moving in phases: quiet accumulation, sudden breakout, aggressive momentum, then late-stage participation. The ETF spike suggests we may be somewhere near the first phase: quiet accumulation. The crowd is still debating. Capital appears to be deciding. And in markets, decisions made before consensus often shape the next chapter. The question is simple: will silver remain range-bound and uneventful? Or are we witnessing the early stages of repositioning before volatility returns? We don't have certainty, but we do have signals. And today, one of the clearest signals we've seen in weeks just appeared, not in price, but in positioning. The market whispered,